Welcome to the Lighthouse Financial Advisors Money Over 50 podcast with Dallas Davison and Michael Hogue. This information is general in nature and does not take into account your objectives, financial situation or needs. Therefore, you should consider whether the information is appropriate for you and your personal circumstances. If you require personal advice, please contact Lighthouse Financial Advisors. Here are your hosts, Dallas Davison and Michael Hogue.
Welcome to Money Over 50's weekly volatility wrap-up with Dallas and Michael. Dallas, today market is down. It's really been no change. So we're down 25% in Australia.
25%, yep.
And in America, down 15%.
Yep.
So, look, this reminds me of the void and mage of the English East India Company back in 1601.
This will be good. You said you had an analogy, and I'm confused as to how you're gonna get from where the market is right now to the maiden voyage of the East India Company. So off you go, mate.
Well, what happened was they were all excited. They formed this new company.
Yeah.
That later went on to be one of the most dominant companies in the world at that time. But they're very excited because they wanted to get that maiden voyage going to the East Indies to bring back some nutmeg and pepper and all different types of spices. So they actually they leased a ship, set sail, and got just off the coast of Dover. Before they just sat there for 5 weeks because there was no wind in the sails. And I feel a little bit like that now as well. So for the last 5 weeks, we've had actually it was 3 weeks that we sat there, but I just had to make it fit in the story. Because
that's right.
The last 5 weeks we have, if we go back 5 weeks ago, was the 9th of April.
Yeah.
And every week after that, it was 25% down. Then it was 23% down. A week later, 27% down. Then 27% down again. Then 24% down. Then and now 25% down. So basically, we have no wind in our sails. And we've so this really should be a 5-minute podcast. We say that all the time.
It's interesting you say that because if you thought of a time, and we spoke about this at great length in pretty much every week for the last few weeks, is that if you follow the headlines or the economic data, there's been so much happen in the last 5 weeks, really. Like, it's been up and down. There's been, I guess, emotionally, as a whole country, as the world, we've been, gone from optimism to pessimism to the world's, there's going to be 1 billion people died, and there's going to be no one. It's all a bit of a much ado about nothing. So you go, there's been a lot of news in the last 5 weeks, but the price volatility has been sort of non-existent, really.
Yeah, look, it hasn't been volatile, and look, markets will do that because coming out isn't unexpected news.
You just broke up. Say that again.
Sorry. What I was going to say, there has been plenty of news, and there's been plenty of bad news, but it hasn't been unexpected news, or it obviously hasn't been unexpected from the market's consideration because markets will react on unexpected news. So they'll either go up in a hurry or they'll come back in a hurry on unexpected news. On the downside, if something gets released that comes from left field, and no one saw that coming, and whatever that could be, then you will see the market likely drop sharply. React to that.
This is I think it was a few weeks ago now that the US had their unemployment numbers came out, and it was 3.3 million people had become unemployed in the last month, which was the hugest, the biggest amount ever on record. And the next and that day on that news, the market went up. And so obviously the consensus was that the unemployment numbers were going to be more than $3 million. And so when that data came out, it was bizarre to watch that horrific economic news come out and then go, the market's up 2% for that day. It was a strange experience, but that's exactly what you're saying, is that news that news came out, but it wasn't unexpected news, and because of that, it was already priced in. And so, in fact, it was unexpected the other way. So the price reacted differently to what you would predict.
Yeah, and you'll see that on the upside as well. So you'll see sometimes news will come out that suggests, for whatever reason, that this thing's going to be over faster than it really will be, sorry, it's going to be over faster than it was expected to be, or for whatever reason, things are going to be a little bit better than what was expected. You'll see the price push up. At the moment, though, in the last 5 weeks, it's just been there's just been no win. So, like the maiden voyage of the English East India Company, there was just no win. They sat there off Dover for 5 weeks. It didn't move anywhere, and they were all excited to get to Indonesia, of course, to trade some spices. So
it's interesting because we were talking about something yesterday, and a point that I sort of wanted to touch on in our wrap up of this was that we started to speak about what we've talked about each week here. Really has been the price of those companies, and we've gone into a fair bit of depth about how that's what you're really looking at is the price that someone's willing to pay for a share in one of these companies. But when we're looking at movement, why that movement probably hasn't been as great in the last 5 weeks is that the underlying thing here, like a terminology that is used a lot in investing, is price to earnings ratio. So it's basically saying the earnings that a company will make as a multiple of the amount of times of that you have to pay to buy shares in that company. So what I think is kind of seems to be happening at the moment is if you look at the earnings of a company, and we touched on this briefly, there's going to be some economic loss. There's going to be some hardship. It's over the next year or two, however long it takes to recover from this. But that's if you're buying shares in one of our big banks in Australia, you have to look at those earnings over the course of the next 30 years. So all of the news that's come out in the last sort of 5 weeks, I don't think that any of that has really impacted what people think will happen in those companies in 5 years' time or 10 years' time. I think that whether you're bullish or bearish on the impact of coronavirus on our economy in Australia, I don't think that anyone's trying to suggest that NAB or CBA or any of these other companies, I don't think that anyone's trying to suggest that they're going to be more or less profitable in 10 years' time based on the news that's coming out week to week. And so if you look at, you're buying shares in NAB, you're buying a part of their profits for the next, say 20, 30 years, if you assume that they're going to be around for at least that long. Whether their earnings are up or down in this next year, it really starts to have less of an impact when you look at it that way. So if you go, NAB's going to make these profits this year, whether it's more than that or less than that, in 5 years' time, if you think, well, we're eventually going to get over this and we're going to get back to how things were, it kind of makes sense that there's not that much volatility in the short term. If that, that was just something that I was thinking about yesterday when we were talking about price to earnings ratio, where you go, it kind of ties in, but then once you've sort of, like you say, the market has digested the short-term news, it's already priced in. It's then not affecting what do I think the earnings are likely to be in 5 years, 10 years, 20 years time.
Obviously, earnings go down. However, the asset base that a company owns, and we're talking collectively here. We're not talking about individual companies necessarily, but we're talking collectively. So, the supermarkets that Woolworths own, the banks that NAB owns, the banks that CBA owns, basically go through every single industry and sector. So the asset base doesn't. What drops in the short term for some of these companies is that the level that people are consuming their core service or products goes down. However, the way that I like to think of it, because oftentimes you hear reports, so many billions been lost, so many trillions been lost. But the last time that I checked, no one was raking cash up and setting fire to it. So it's not lost. It just goes into hiding for a while. And if you look at that across the population of Australia, for example, people, money will go into hiding for a period of time. So people will tighten their belt. They'll save money. Now, that doesn't get spent on those companies' core product or services for that period of time. However, the money does not disappear. It actually sits in people's bank accounts. What happens is when they're confident again to spend that money, or they can physically go out and go to a restaurant or go to a pub and spend that money, they spend that money. Now, they bring more ammo to the fight, because what they have is they've had all these savings that they've actually put it. And people, we don't want to get bogged down on the minutiae here, because people listening to this may argue with me and say, okay, well, what if you don't have a job? Well,
there's arguments of supply versus, supply demand versus.
We're talking collectively across the board. So money will go into hiding for a period of time, but then it comes out. Now, when it comes out, what you find is that the profits or the earnings, or the profits of those companies, they springboard back fairly quickly, because they have the same asset base. So they actually have the same asset base. They have the same product base. They have the same service base. It wanes for a period of time, but it actually just springs back into action. So that's what you can see. That's what you do see when recoveries occur. They happen quickly very often because of that reason.
Yeah. Well, and that's I heard a great a comparison the other day about the economic impact of coronavirus and why it's, I guess, probably surprising for a lot of people that there's less volatility. Now that the sudden movement has happened, we've all sort of reacted to that, and now there seems to be less movement. It's, as you say, those assets are not disappearing. And so if you compare the pandemic to something like the World War, during the World War there was huge amounts of there was a lot more volatility, and asset bases were changing a lot, if that makes sense. So you say your example of your banks were actually getting bombed, and people who worked in those banks were, the people who were bankers were dying in great numbers in those sorts of most productive years. What you're having with the coronavirus is that those assets are not disappearing. So like if you look at all of the restaurants and all the pubs in Australia, no one's setting fire to them. That asset still exists. It's still got a kitchen there. It's still got all the furniture. The minute we can turn the lights back on, again, you get bogged down in the demand of, well, do people have income to spend, all the rest of it? But the asset itself has not disappeared. So whether it's a restaurant around the corner from you, or a NAB branch down the street, or a gold mine in Charles Towers, those assets still exist. It's really just a matter of when will those earnings get back online and get back to where they were. But as a percentage of the lifetime of that asset, if you own a restaurant for 30 years and you have 6 months of downtime, it's normally, it shouldn't really fluctuate your price that much, because you've got 30 years worth of earnings that's got to tie into it.
Yeah, look, and that's what inevitably happens. So life does get back on track. Yeah. And right at the red hot moment when people are in whatever is causing the value of their superannuation funds to drop, a lot of people just can't. They extrapolate too much, and they say the world is ending. It's I have to get out now. I have to get out now. This thing is going to zero, because they really don't understand it. They understand that their house, you can't go to zero, because there will be some flaw there where someone will want that. The price might drop, which a lot of people don't understand either, but the price might drop from $700,000 to $500,000. Someone will snap that up when it gets low enough. And that's kind of what we've seen. That's what happens with the great companies of Australia and the world as well. So the price will drop, but someone will snap that up at some stage when it drops low enough, because they'll see value in that. And they'll see value in that as a discount. So people make a mistake where they think they over extrapolate and think this is on its way down. If you look at the last week's worth of returns, it was negative 20%, for example. Oh my God! If we tackle another 4 weeks of this,
we're at zero.
We're at zero. So that's where they tend to panic. But certainly the asset bases are there. Just as your family home, it's an asset base. It will drop to a certain level. Someone will come in and snap that up, the lower it drops, because they'll see this is real good value here. I can get something that may be worth $700,000 again. I can get it now for $500,000. I'm going to jump in and buy it before someone else does. That's what you see when the markets drop by 25% and 15% respectively, or they drop way further and then they have a small rebound.
Come back to that.
It's because people are coming in and really seeing, okay, there's a tremendous opportunity here to actually buy for a discount. So
I think that's a good analogy and a good way to wrap up. As you say, our weekly updates that have been fairly consistent over the last 5 weeks. That's kind of where things are sitting. There's been exactly that. There's been some panic, and then there's been some sort of realization of maybe this isn't going to be the end of the world, and this is where there's been some buying come in and bring that price back up, and now things are sort of sitting there waiting to see what happens. So really, who knows what will happen next with price movements, but I guess that's the important thing the point for most people to think about, is that there are these underlying assets, there are these underlying companies making profits, and that's what you own a part of, and that's the important thing to keep in mind.
Yeah, and we talked about this before, and to our listeners, what we were going to do is we're actually going to put this Saturday morning podcast on hold for a period of time, only because we just, like, as we discussed before, we just have no wind in ourselves at the moment.
It's kind of one of those things. I think the point of what we've tried to do over the last month or 5 weeks, whatever, is to, I guess, be a bit of a voice of reason when things are very emotional, and there is probably
the entire point of this. The entire point of this Saturday morning is spot on there, Dallas, because we can lose sight of that. We aren't market commentators at all. And it makes no difference. And some of the times we're talking about some of the stuff in these Saturday morning podcasts, I'm thinking, I can't believe this is coming out of my mouth. Look, it's not because it's not true. It's because it just doesn't matter in the grand scheme of things. So the whole reason this Saturday morning podcast got born was to help people, like you said, to be a voice of reason and not to make an emotional decision.
Yeah, and I think we're now at the other side of that, where it seems to me like there doesn't seem to be the same level of either panic or euphoria. There isn't the same emotional reaction to what's happening, and so I think, like you say, it's a good place to wrap it up and go, okay, well, if you've been able to, which is hopefully if we've been able to help in any way, keep people focused on the long term and what is really happening behind the scenes, and keep people focused on their long term goals and needs, then that's really what we've tried to do. So I think we've hopefully been successful. Even if there's someone out there that we've helped to stay the course, and they've been able to not react, not panic, and not sell at this point in time, then it's probably been successful. Yeah,
that's a great point to finish off, I think. And we'll still be releasing at least one podcast a week, a regular every Tuesday.
Yep.
And also on a Friday, some of the time as well, or most of the time. Oh, we're on 2 a week now, aren't we? It's hard. I've lost track.
We have to talk to our producer and sound engineer Ali as to what the schedule is. But
that's
we just record podcasts and we're told to, so let's just stick with that.
Yes, but we'll say at minimum it'll be one per week on a Tuesday morning. So to all our listeners, thanks for listening. We really enjoy podcasting, and hopefully everyone that's listening is getting some benefit and enjoyment out of that as well.
Yeah. Thanks for listening.
Thank you for listening to the Money Over 50 podcast with Lighthouse Financial Advisors. We look forward to catching up again soon.